Welcome to Behind the Returns. This is your host Arun, and I head the mutual fund research at FundsIndia. As always, we have a super interesting guest with us. We have Mr. Shreyash Devalkar from Axis Mutual Fund. He manages their large cap offering Axis BlueChip Fund and their multi cap offering Axis Multi Cap Fund, and also their mid cap offering Axis Mid Cap Fund. Hi Shreyash, welcome to the show. So, Shreyas, broadly, when we were looking at the large cap mutual fund space, we realized that a lot of active large cap fund managers have underperformed in the last 3 to 4 years. Now, obviously, that being said, Axis Blue Chip has been a significant outperformer in the same phase. So, two questions, Shreyas. One, what's changed in the last 3-4 years that all of a sudden a lot of large cap active fund managers are underperforming their passive benchmark? And two, the natural question being that what has Axis done differently that is leading to this significant outperformance even during a phase where a lot of active fund managers, especially in the large cap space, have underperformed? So what was the thought process, and could you take us through the journey of the last 3 years in terms of your portfolio construction?
Sure. So if you notice market, especially from 2018, 19 and pre-COVID 20, because post-COVID 20, there are different legs to this rally. But during that time period, 18, 19 and till March of 20, you would notice that market has polarized for various reasons. It is not only in the large caps, even in the small and mid caps also only few companies performed. In large caps, again few companies performed. Market got polarized, and in Nifty itself, the weightages of two stocks became very high. And when the market polarizes, then the probability of going right when you choose a stock comes down, right? So if out of 50 stocks you choose, if only in the market out of 100 only 8 are going to work or 10 are working, then your probability is down to 10%. If in the market there are 30-40 stocks are working, then your probability is 30-40%. So unless you are in that 8 to 10 stocks, then the chances of doing well becomes very narrow during this kind of market. And that polarized market during that time was, in my opinion, posed challenge for everyone. When it comes to Axis Blue Chip Fund, probably in 2018 beginning, we saw probably that some of the sectors are not performing as well, and we had gone very narrow in terms of stock exposures in Axis Blue Chip Fund. So Axis Blue Chip Fund, actually, if you notice that the last 2.5 years is carrying 829, so very narrow number of stock, and probably in a hindsight one can say that we would have selected that 8 to 10 stocks. Out of that, probably majority were with us in good quantity, because the portfolio was also concentrated, and that would have helped. What exactly would have led to selection of those stocks is, in my opinion, market is following quality and growth. Not only in last 2-3 years, but for last 10 years. And whenever there are challenges in growth, then the market even more narrows during on that theme. And we at Axis has always focused on quality and growth and tried to be more objective about it. So just to give example, beginning of 18, I would have had autos somewhere around 50 to 20% in Axis Blue Chip Fund. But when we saw that the growth is coming down, I would have reduced it to as low as 3 to 5%, and many such things. So net being objective, trying to be objective on quality and growth, and especially on the growth, because anyway quality is what we always follow. But when it comes to growth, then certain sectors may change their growth profile, and the trick here is whether that change is going to be there for 6 months or for 2 years. That judgment is important to take, and somehow some of those judgments would have gone right. Probably in hindsight, luckily it would have gone right, and that's where this fund would have done better.
Sure. Shreyas, when we were looking at most of Axis funds vis-a-vis the other funds in pure traditional valuation parameters on a broad portfolio level, if you look at price to earnings or price to book, usually we've seen the pattern that Axis mutual fund is slightly on the higher side when you use these traditional metrics. Now, obviously, the answer can be that high quality will obviously require some bit of higher valuations as well. But there's also a camp which is saying that, hey, in the last, let's say, 5 years or 10 years, growth has been really scarce, and hence the quality names with growth became more and more expensive. But again, at some point in time, when earnings growth might come back and the growth gets a lot more broad based, then quality as a pack might face some pressure in terms of purely on the valuation. So, as a fund manager, how do you view this kind of an environment, and if in case this thesis has to, comes to play out at some point in time, how do you broadly look at this scenario, and how do you approach it from a portfolio perspective?
Okay. So when it comes to quality and growth as to this parameter, it will always be expensive. So if at the index level of or Nifty level of 8,000 also quality and growth will be expensive compared to the other stocks during at that time. At index level of 13,000 also same thing. So quality and growth will be expensive always. Then there is the only question of relative. So relatively they will be expensive. Sorry, there's the only question of absolutely what is that expensive, which is where you are okay, and what is that expensive where you are not okay with. In that scenario, what we try to do is, again, as I use one word of being objective. So you should be objective on your quality and more importantly on growth. So if you're using right pedigree of the promoters, right businesses where ROEs are don't suddenly come under pressure, cash flows don't suddenly come under pressure. So if you're right on that, it is the quality probably takes care of itself. But more important parameter is growth, which keep on changing because businesses are cyclical. The way I explained in auto in 2018, post pandemic again the pecking order of growth changed. So post pandemic suddenly you notice that the retail credit growth, which used to be the fastest growing sector, suddenly there was a question on whether credit growth will be upwards of 5 or 10% or not, because the best bank and NBFC are also talking about single digit or mid single digit growth by fourth quarter, and suddenly the relative growth has come down. So in this scenario, one need to be very careful and objective about relative growth. When you can capture that relative growth very well, the valuations and everything gets taken care of, and you eventually end up shifting from one to other. So I would again try to summarize that, trying to be objective about both growth and quality. Assuming quality don't change much, you need to be more and more objective about growth. And if you are able to do it, then this valuation part, it will take care of itself. That's how I would normally look at it. Because in quality, there is one more angle that when something is expensive, then the highest risk that stock carries is not that of growth. There are ample examples. I'll give you example of many QSR companies, many companies where, or especially in the food industry or in the consumer sector, where the sectors used to grow at 25%, 30%. But then eventually the growth came down. But in that scenario, though absolutely it came down, but the valuations didn't correct during in those stocks, because the relative growth stood out still in those sectors. So you need to be very objective about that relative growth. You need to be objective about quality and the disruptions in the business, whether the company you are owning is capable of tackling disruptions. Now you just take last few years, and you take now consider financial services sector. Which bank and NBFC would have withstood the pressure created by a pandemic? Before that, IRNFS crisis, before that, demon, before that, probably during the twin deficit crisis. So there are multiple challenges in the environment. The companies which show that they can withstand that pressure and come out well after that. Such companies generally are the ones are always expensive, and but then if they are able to do it, then you need to be very much focused only on the growth, and probably the rest takes care of it.
Right. So, Shreyas, when we are looking at the performance of Axis BlueChip, you also realize that if you go back 4 years back, which is ideally the period where somebody should have invested to get the best out of the fund in the last 3 years. But if you look at the 3-year performance back then, we found that most of Axis funds were going through a lean patch where most of the funds were actually underperforming the majority of the peers, both in large cap and as well as the other. So just wanted to understand what really happened during that phase, and how did the whole performance turnaround happen. So how should somebody look at it? Because the philosophy remains the same. So why did this philosophy underperform at that juncture, and why did this outperform dramatically in the last 3-4 years?
Okay. So pre 2016, my at least judgment as outsider, as I would use, because I started managing from 2016. But my judgment on that, why it would have underperformed, what would have been the reason, is it was especially 2015 end to 2016 was a rally wherein many stocks performed across the board, whether uh, and the market in that, whether it was quality or growth or not, but everything performed during that time, and especially during that fag end of that rally, which was in 2017, no, 2016 actually. During that fag end, probably the best stock which this fund had, they would have already given you return in the year prior to that, and that's where in that year they didn't perform much, and that was one of the reasons which would have dragged the previous 2 years returns prior to that. But it was, in my opinion, the 1 year which dragged the performance of previous 2-3 years, and because of this reason, because that rally where the good quality stocks we were having, they would not have performed during that time. A similar, so whenever market rises from the bottom sharply, at that time everything does well. So you take even the market which has this year itself, from April beginning till now, probably everything would have doubled. Not everything, but then most of the companies, which because they fail so much, and then those things are very crucial to analyze that how then the fund would have done from earlier level before the crash, after the crash, and what was the cumulative performance. So if those analysis, if that way one does analysis, then it shows how whether the companies which we own in the fund are performing to the expectations or not.
So, Shreyas, just an extension to the same point. So eventually, at some point in time, once you follow a particular style, the style will inevitably have its own phases of underperformance. So, for somebody who is invested into your fund right now, in the future, at some point in time, let's say the fund underperforms. So, how should we differentiate between something really going wrong with the fund? Because you can always justify an underperformance saying that it is my style which is going through underperformance. So how does a customer who's invested in your fund differentiate between a genuine underperformance where he has to worry vis-a-vis the normal underperformance, which is like something like you told in 16, 15, which happened, which is nothing but it's a temporary blip, and then again the style will more than compensate during its out. So how does somebody differentiate between both of these?
That part is obviously the answer you get always in hindsight to such questions, because while we are running, what I told is whether the way I personally as a fund manager would like to do is whether I am being objective, and whether that error, so if underperformance come, whether that error of underperformance, what I attribute it to, whether it is because I missed that change in the pecking order of growth, whether it is because of the reasons which I told that my stocks would have rallied earlier and huge outperformance came. After that, everything else went up, which you don't own, and now there is underperformance because your stock already did. So that judgment obviously for me becomes relatively easier because I am day to day running it. For the outsider who is watching it, there becomes slightly tricky. How would you judge that? But from my side, at least, what I try to do is try to be as objective I can and try to shift wherever you see any dent in quality or any change in the pecking order of growth, and that continuous focus is what is the attempt, at least from our side. That's what I can say. But it because I agree that it becomes very difficult for someone to just look at performance or look at portfolio, what is actually hurting it, and whether it will. And more important is okay, whatever has happened, but more important is what next. That judgment is very tricky. So it's more on whether I am or as any fund manager trying to be objective with his philosophy or not.
Right. So, Shreyash, again, a small extension to the same part. Now, when you say quality, can it be objectified, or can it be put into rules to a large extent? Let's say somebody looks at the past ROE, ROC numbers, or debt to equity. Will that be a rough representation of checking if the quality parameters are being followed?
So quality, you can talk about quality in a qualitative manner, like mode, competitive advantage, and value addition, whether the company is doing or not. That is okay. That is the qualitative aspect. But we try to focus more on the quantitative aspects. And the quantitative aspects of quality are whether return on equity is high or not, whether company is paying full tax, corporate governance is gets reflected in many of the quantitative numbers also. The capex to sales ratio vis-a-vis other industry companies. It also gets reflected into the free cash flow generation. So in one sector, why one company generates high free cash flow, why other company generates low free cash flow, and those free cash flow to PAT ratio is what is again one of the important parameter in assigning price to earning. We normally tend to believe that P is just a function of growth, but it is not. It is a function of how strong the free cash flows are compared to your PAT. Because as it's always said that profit is just a number, because in some companies, if profit is 100, in some companies the free cash flow generation is 50, in some companies the free cash flow generation can be 150. So the company which is generating free cash flow of 150 will obviously get higher PE, because there the free cash flow generation is high. It is more than your PAT. So these things are important while judging the quality of business, and those things we definitely use in our analysis, in the quantitative analysis, because as I said, the qualitative part is I can explain any company that yes, it is a good value add, there is a competitive advantage and all, but then if it doesn't get reflected in the numbers, then there is a issue. So it is not that having said that, I would not say that all of my holding companies would have excellent ROE and all, but then I try to restrict. So I would try to restrict exposure to such companies where ROE is low to about 10%. And and whenever you are adding, you should be having that clarity that yes, that ROE why you are adding it is not for current ROE. You are expecting it to improve, or free cash flow generation you are expecting to improve. And if it doesn't, then again I will come back to the same thing. Try to be more objective. Reduce the weight. That's what I tend to do. So if that company don't deliver on your expectation, then reduce the weight. Doesn't matter. So these are the things which I would now normally try to stick to, and try to be again coming back to that. Try to be more objective on these numbers and these analysis.
Got it. So, Shreyas, yet one more question. So broadly, if you look at the global context, you're seeing that a lot of active fund managers globally are finding it extremely difficult to beat their passive benchmarks. So, when you're looking at it from an Indian perspective, as an Indian fund manager managing a large cap fund, what's your reading of this as to why is this happening? And for somebody sitting in India and deciding, saying, hey, is this a time to move to active, or let's say, is this a time to move to passive or active? So how does somebody look at it from an Indian context, and especially the large cap space, given the fact that the last 3 years we've again seen that a lot of fund managers have also underperformed on the last. So is it something to really worry, or is there any nuance that we might be missing, and not just extrapolating what is happening in the global front to here?
So yeah, so on the global front, frankly, it is not right on my part to pass a comment on why they would be underperforming, because I have not frankly analyzed the way they operate and how and why it would have happened. When it comes to Indian context, and especially in last 3 years, as I highlighted earlier, it is about probability of winning. So in a narrow market, the probability of winning comes down. You select 50 stocks. Out of that, only out of probably top 100, the large cap fund, as you know, are top 100 companies. And out of that, only if top 8 to 10 stocks did well in last during that time period, especially 18, 19, and pre-COVID 20. During that time period, only few stocks did well. So it was you had it or you don't have it, and that probability coming down has affected, in my opinion, the performance. So as and when, and especially post-COVID world, probably you will notice that the market is more broad-based, and more companies are performing. And if with the transmission of interest rate in the economy, if more and more sectors start doing well, then suddenly the probability of winning goes up, and then out of top 100, 30, 40 companies do well. And with that probability of winning, then the chances of outperformance increase in the market. So that's how, at least, I look at this. And so that's what one should keep in mind while analyzing and try to extrapolate what has happened in last 2.5 years.
Also, with regards to ESG as a new emerging theme, because Axis, I mean, you already follow quality and growth as a primary parameter. Would it be fair to assume that most of your companies will anyway be ESG compliant? So how does ESG form a part of your thinking?
As you are aware, probably Axis, we are also having a ESG fund as well. So we have that in our process to classify or rate or rank company on an ESG basis. When it comes to the portfolio of, say, Axis BlueChip Fund, then now if you look at, if you just dissect what is ESG, out of that, G part gets taken care of when you are talking about quality, and then the corporate governance is the major element of quality, which remains qualitative. When it comes to E and S, then most of the companies, if you notice that, which are good on this front, E and S, are so which are the sectors, probably, if you take other way around, that which sectors which you don't own, and probably they are ranked less in E and S. Mostly what we have observed is, as we try to focus on quality and growth, most of the sectors which are growing very fast are ticking on the E and S criteria. And that's where, if you notice that, so what I talked about is retail credit growth is fastest area. Now, financial services, entire financial services probably would be on E and S. If you talk about consumer B2C businesses, then that entire piece would take on E and S. So that's where, when you talk about the growth, then these are the sectors which are one of the fastest growing sector, and that's how somehow you end up having majority ESG compliant companies. As I said, we have process to identify, because anyway we are having a fund, and but having said that, it is not that in Axis BlueChip Fund I would restrict one company just based on that parameter, but it is observed that the fastest growing and good quality companies are broadly ticks on the ESG parameter. And that's where fund also having more majority of.
So, Shreyash, the other question was, you run fairly concentrated portfolios, especially your Axis BlueChip Fund. So if I remember earlier in your previous avatar in a different mutual fund, you also had taken a large exposure to telecom, and it took a long time to play. So just wanted to understand what were the lessons from taking these kind of concentrated risk, and how are you inculcating those lessons in the current concentrated portfolios that you're running? What's been the big learning from that experience?
Especially when it comes to, so your question is more on concentrated, I assume, rather than telecom and
Yeah, yeah,
that piece. So concentration risk definitely is one need to take care of. And that's where again and again I am saying that being objective on quality and growth becomes important. Now, in that concentration, uh, are you concentrating on good quality companies? Then at least it's protect you when the G part goes wrong. That is the growth part goes wrong, right? In the quality and growth. So that protection you buy by buying good quality companies. So even if some sector is growing at say 10%, and suddenly you realize that no, that is not 10, it is 7 or 6 only. But then if those are companies are quality companies, then it protects you on downside. If you miss in picking that change in the picking order of growth. Uh, but then the solution is to be with good quality companies so that the downsides are protected. Uh, Try to see to it that sudden disruptions are not the very nature of your business, and probably again just take back your example of telecom. So that is that I can use as a learning also here, because that sector probably didn't have that element, and that's where when you now also try to choose any company which is probably heavyweight in the portfolio, then I normally talk about see to it that the ROE is high, and the management is good. There is not too much of the competitive activity. There is the business is not very high uh, capital intensive, and those things are very much important to notice, and probably some of those were not picking in the telecom as a sector then. So definitely those are the learnings, and that you try to inculcate here as well. And as far as concentration and diversification is concerned, yes, now slowly this fund is also being diversified. So you would have noticed probably at a point in time this fund would have had 20 to 23 stocks also. Now it would be somewhere around 27 to 29 stocks. So eventually it will go up from here on. And I hope that economy gets broad-based and more number of stocks. So I am not bound by any minimum or even maximum number. It is not that I want to run a 30 stock or 25 stock portfolio. That was never idea of running this fund. I ended up eventually because the economy got bad. If the economy becomes broad-based, I am more than happy to take it to 30, 35 stock portfolio. And probably since we saw few indications of that in the recent result season, you will notice that yes, the fund has got broad-based across sectors also, and by way of number of companies also. So it will broad-based as we see economy is seeing broad-based improvement.
sure. So, Shreyas, the other question is, how are you reading through the entire market rally which has happened recently, and how are you positioning your portfolios for the future?
See, market rally is always difficult to predict, and probably 6 months ago we would have spoken, and you would have asked me whether market can go to 13,000 by November. I would have said no, and it is there, right? So it's very difficult, and that's where always it is said that look at the companies rather than the market and focus on that. So that's what we also would try to do. This rally, the way I look at it is as one can we have seen impact of two things. One is the very attractive fiscal and monetary policies in the Western world and what impact it can have on the valuations. Again, equity is one of the longest duration bond, right? And that's where the lower interest rates so obviously takes up the valuation up, and so that element has definitely played a role in it. But second, more important role, instead of attributing everything to the liquidity, the more important thing which one would have observed in last two seasons quarterly results are important. Economy has shown much more resilience than what was feared in April, May. You take sector by sector. If you take financial services, then what was feared on asset quality front and the reality by end of September was different. Again, you don't know what happens in March if pandemic continues. That's a different point altogether, because some borrowers may have a different ability of withstand this, and their ability to withstand this for how long, that differs from borrower to borrower. So some would have been able to withstand it for 6 months, some would have been able to withstand for 1 year. But then net the outcome as of end of September was much better than what was feared. You take many other companies in other sectors, they have shown excellent control on cost and cash flow management. This has been one of the ideal quarter on the margin front and cash flow management. Again, you can't extrapolate these margins to future and give it multiple, but point is that shows the resilience of business. And most of the listed companies which are organized, they have shown it. And this is where the market is where it is. It is not about that we expect a recovery and economy will go back to whatever double-digit growth in nominal terms. It is not about it. It is about how strong companies have shown their ability to withstand this crisis. There has been margin improvement that may not last, but it shows the resilience of the business model. And these things actually market has valued during this time. But having said that, yes, and that's where on a relative basis, market has valued all these things. On absolute basis, as I said, the market will always is always expensive. So at a lower point also, you would have said that this is expensive for the earning cut you expect. And today also we can say that yes, it is expensive for whatever recovery we are expecting here.
Sure. Thank you so much, Shreyas, for all the insights. Really appreciate your time.
Thank you.